All right, here we go. Non-farm payrolls for the month of September on the big jobs report. 263,000. 263,000. Now, if we go back, this is really fascinating because 263,000 is the low water mark going back to April when it was 263,000. 288,000 is private payrolls. And if we look at the change in manufacturing payrolls, it's about as expected, a pretty robust 22,000. The unemployment rate, or U3, is 3.5%. Equaling the July read, which is the low water mark. And in this case, bad news, good news, bad news. Maybe you don't want to see unemployment rates moving lower. And if we look at what's going on with earnings, up 0.3%. This makes 2 months in a row it's up 0.3. That's month over month. Year over year, it's up 5%. As expected, a downgrade from 5.2, which we've had the last 3 months. And if we look at the work week, 34.5. 34.5 equals our last look. 34.9 actually is the number you want to comp to with regard to history. That is the higher watermark. And finally, if we look at what's going on with U6, the underemployment rate, that's 6.7, and that equals the best level. We've had a couple of 6.7s in June and July. Okay, labor force participation rate, always a favorite, but in this case, it moved in the wrong direction. 62.4 in the rearview mirror, and expectations take a tenth away, moves to 62.3. 62.4 is the high water mark there. If we look at interest rates, well, we are now up 5.5 basis points in 10s that were virtually unchanged at 383. And if we look at 2-year note yields, they've jumped up to 432. They were at 428, up 3. So now they're up closer to 7. And of course, what's going on with regard to Lisa Cook? Fed Governor Lisa Cook yesterday said, don't worry about global events. Our mission is domestic, and I agree with her. But I think that the energy-induced recession the globe's looking at is going to send feedback loops of wave after wave after wave. I think they'll get the Fed's attention eventually. Panel, Becky, back to you.
All right, Rick, stay right there because we've got lots to chew through right now. You can see the futures on all of this turning a little weaker. But as Rick mentioned as he was talking about that, the unemployment rate below expectations, and we're probably in a market where good news is bad news in this weird, twisted way where we're waiting on the Fed, and anything that makes the Fed less likely to slow down, the market reads as bad news. Dow futures now down by about 119 points. The NASDAQ down by 141. The S&P down by 27. Steve, you've been digging through these numbers. What else jumps out at you?
You know, it's not maybe quite as strong as it appears, and I'll explain why. When I look through these numbers, I look down the column. I look for negative signs or positive signs. There's a bunch of industries that were kind of negative, not in a big way, but if you just look, there's a whole bunch of negatives. I have to look at what they call the diffusion index. It tells us the percent of jobs, of industries that had job growth. I will tell you that the biggest chunk of this was, first of all, it was private sector jobs, up 288. Education and health services up 90, and leisure and hospitality up 83. So what is that? 170 of 280. There was a loss of jobs in local education. I think that might be a seasonal adjustment issue, but government overall was negative 25. So I don't think this was broad-based strength. I think what I'm seeing when I look at this is a rebound in some sectors that are still, by the way, down. Going into this, we were down 1.2 million. I don't think this changes the Fed very much because there is a school of thinking, Becky, that we can get into all of these numbers and go way down into the weeds. The only thing that matters that really tells you what you need to know about the job market is the unemployment rate, and that ticked down. And that may be the thing the Fed looks at and it's going to say, you know what? Forget all this other stuff. The job market remains tight, and in fact, it's tighter this month than it was last month.